Joyce has just stepped up for his announcement after this financial result announcement from this morning.
In December of last year. This morning, Qantas announced an underlying loss before tax of $646 million. This underlying results reflect the cumulative effect of 2 years of market capacity growth outstripping demand. A record high fuel cost of $4.5 billion, up $253 million on the prior year. Weaker demand due to an environment of lower consumer confidence will reduce activity by business, particularly the resource and government sectors. The statutory loss after tax of $2.8 billion reflects the underlying loss and the cost associated with our $2 billion Qantas transformation programme, including redundancies and early aircraft retirements. It also includes a non-cash write-down of $2.6 billion to the value of the Qantas international fleet following our structural review and as required by accounting standards. I foreshadowed today's results at our half-year announcement in February, declaring it unacceptable. There's no doubt that today's numbers are confronting, but they represent the year that is past, and we have now come through the worst. With our accelerated Qantas transformation programme, we are already emerging as a leaner, more focused and sustainable Qantas group. Our work is on track, and we see accelerating benefits in the coming year. The changes arising from the structural review will deliver significant short and long-term benefits. Importantly, there is a clear and significant easing of both international and domestic capacity, which will stabilise the operating environment in which we are in. We therefore anticipate a rapid improvement in the Group's financial performance in financial year 2015. The Qantas Group expects to deliver an underlying profit before tax in the first half of the year, subject to factors outside of our control. Turning to the key points in this year's results. Both our Qantas domestic and Jetstar domestic businesses were profitable over the year. In all likelihood, the only profitable airlines in the domestic market in a year of unprecedented competitive activity. Group domestic earnings were just below $50 million, and revenue declined relative to the prior year due to a second consecutive year of market capacity growth well ahead of demand. Both airlines delivered unit cost improvements, offsetting some of the revenue decline and higher fuel costs. Qantas International is transforming at speed, with $400 million of costs removed over the past 2 years. However, these achievements were offset over the same period by revenue decline, again due to competitive activity and growth running ahead of demand, and fuel cost increases which were significant for this business. Earnings recovery in Qantas International will continue to be driven by removing costs and from easing back of capacity oversupply. The Jetstar Group also delivered a 2% unit cost improvement, and business fundamentals remain strong. However, due to competitive intensity and capacity oversupply in Australia and Southeast Asia, yields were adversely affected. Qantas Loyalty recorded its fifth straight year of double-digit growth, another record result in a great business. The Group finished the year with a strong cash position of $3 billion, a decrease in debt, and total liquidity of $3.6 billion. With 2 recent landmark bond issuances totalling $700 million, the Group debt maturity profile has been significantly extended, with now no major unsecured refinancing required before April 2016. The Group also reported an operating cash flow of $1.1 billion, leading to a neutral free cash flow result, despite the significant cost associated with the Qantas transformation over the period. Now to our progress with our accelerated Qantas transformation programme. The reality is that we are undergoing the biggest and fastest transformation since the privatisation of Qantas in 1995. Our transformation is about working our assets harder, making our business smarter, giving even more to our customers, and reshaping our operations for long-term sustainable success. We are only 6 months into that programme, but we front-loaded many of the more difficult employment and restructuring measures so that well ahead in terms of execution of our major plans. The measures announced in February led to a significant redundancies, of which 2,500 have already taken place. By the end of full year 2015, 4,000 of the total 5,000 redundancies will have occurred. The 5,000 redundancies will conclude the period of major job reductions at Qantas. And over the course of the year, the Qantas Group unit costs were cut by 3%, 2% in the first half of full year 2014 and 4% in the second half, demonstrating the growing momentum in the transformation programme. A total of $440 million in benefits was delivered in 2014, including $204 million from the accelerated transformation programme. A further $900 million in initiatives is already underway, with more than $600 million in benefits to be delivered in the financial year 2015. Net debt was also cut by nearly $100 million, with an expectation of more than $1 billion of debt reduction in total by the end of the current financial year. Importantly, for our balance sheet, we now see our net debt to EBITDA peaking in financial year 2014, with earnings improvement and debt being reduced from this point going forward. While we are aggressively cutting our costs, we are creating even better experiences for our customers, because the customers are at the heart of everything that we do at Qantas. Our targeted investment programme supports the Qantas brand promise and yield premium every day and for the long term. We're investing in new international lounges and even better in-flight entertainment. We're updating the cabins of the A330s and the 737-800 fleets. We continue to innovate with great Qantas loyalty options like Qantas Cash and the Acquire programme. We keep investing on our people to deliver outstanding customer service. And as a result, Qantas leads on key indicators including customer advocacy and on-time performance. We have already achieved a string of global and national awards and recognition. For the Jetstar Group, we are investing in the Boeing 787 Dreamliners, hitting record customer satisfaction levels across that portfolio, and continuing to improve the customer experience from booking to destinations. In December last year, I announced a comprehensive structural review of the Qantas Group. That review is complete. The review identified opportunities to divest some non-core assets, such as airport terminals, property and land holdings. Valuations were undertaken. Some assets have been sold, including the Brisbane Airport terminal lease, and we continue to assess opportunities where these will lead to enhanced shareholder value. The proceeds from sales will be used to pay down debt. We also considered a partial sale of Qantas Loyalty. Due to the strong support of our customers and partners, Qantas Loyalty is a standout business, achieving a new record result for the year with double-digit growth. After careful consideration, our judgment was that Qantas Loyalty continued to offer major profitable growth opportunities, and there was insufficient justification for a partial sale. To continue to realise the value in Qantas Loyalty, we will be innovating, investing and working closely with our partners and rewarding the loyalty of our customers with even more ways to earn and redeem Qantas points. We also looked at the Jetstar ventures in Asia. In the world's fastest growing aviation market, this is a major long-term opportunity that we continue to believe in. No new Jetstar ventures will be established while the group is focused on transformation. But we know that substantial value exists across the Jetstar Airlines, and we will realise that value over time. Since 2012, in order to strengthen accountability and performance, we've reported the Qantas International and Qantas Domestic business as separate segments. The Australian Parliament recently decided to soften the foreign ownership restrictions in the Qantas Sale Act. In fact, this was only signed into law on Monday of this week. And as a consequence of this decision, we have decided to create a new holding structure and corporate entity for Qantas International. This will have no impact on the day-to-day operations, network or staffing at Qantas International. However, this structure increases the potential for future investment. It will create the long-term option for Qantas International to participate in partnership opportunities in the international aviation market with a view to achieving further efficiencies and improving returns to shareholders. The decision to create a separate holding structure and entity for Qantas International has triggered an accounting requirement to test the value of Qantas International assets on a standalone basis. The international fleet was purchased when the value of the dollar, the Australian dollar, averaged 68 cents against the US dollar. And for some of the aircraft, the 747s in particular, that was 57 cents. Today, the Australian dollar is trading at 93 cents. The value of these aircraft on our book has therefore been written down by $2.6 billion to their current market value. As a result, future Qantas International depreciation expenses will be lower by around $200 million per year. Importantly, this is a non-cash charge, a book write-down to the carrying value of aircraft that Qantas has no intention to sell and will retain in its fleet. It will have no impact on the economics of the business or change cash flow forecasts. So let me conclude. Everything we're doing is about building a sustainable premium airline model for the 21st century. Over the coming year, we anticipate continued high competitive intensity, but capacity growth is clearly and significantly easing in both the domestic and international markets. International competitive capacity growth in Australia is expected to be below 3% for the first half of 2015, compared to an average growth of 8% over the past 4 years. In fact, it was 9.5% last year alone. Overall domestic capacity growth in the first half of 2015 is likely to be around 1%. As you know, we froze the Qantas domestic group capacity growth for the first quarter, and we have decided to extend that freeze for the second quarter, meaning no capacity growth for the first half of 2015. We believe that this is appropriate given the underlying market conditions that we see. However, we do maintain significant flexibility within our fleet and operational envelopes to respond swiftly should market conditions and our customer proposition require it. So, by the end of our transformation programme, we'll have dramatically reduced our cost-based disadvantage in Qantas Domestic compared to our competitor to under 5%, and significantly reduced the Qantas International cost base. Our organisational structure will be clearly aligned to our strategy, with Qantas International in a separate entity to provide future options. And our capital structure will be stronger through the generation of positive free cash flows, with further asset sales used to repay debt. Finally, I want to thank the employees at Qantas. The transformation of our business is a difficult process. They have responded with great courage and good spirit to the challenge that we face, while maintaining the highest standards of performance. Due to their efforts, the national carrier will be far better placed to deliver for our customers, reward our frequent flyers, serve Australia and build long-term shareholder value. We still have more to do, but we have come through the worst, and we have a clear evidence of a brighter future. As I said, we anticipate a rapid improvement in the Group's financial performance in financial year 2015, and subject to factors outside of our control, we expect to deliver an underlying profit before tax in the first half of this year. Thank you. What we're going to do now is open it to questions, and I'm going to ask Olivia to coordinate it so people can make themselves known to Olivia and ask questions to myself or Gareth. We're happy to take them now.
Hi, it's Jamie Freed from the Financial Review. Just have a couple questions.
Sorry, Jamie, I can't see you. Where are you? Oh, there.
Sorry. I guess with this domestic-international split, does this mean that you plan to keep 100% of the domestic business but to sell up to 49% of the international business?
So what we are doing is setting up a holding company. We are setting up a holding company for Qantas International as a separate corporate entity to create options for us into the future. And at this stage, those options could be mixed and varied, and we're not going to speculate on how they could occur. But this is aimed at allowing us to seek further investment, future investment around the international business.
Okay, and then I note that your depreciation charges in international are coming down by $200 million a year. So when do you expect international, combined with that and the cost cuts, to be back into profitability?
Well, the whole focus of the transformation programme of delivering $2 billion in benefits over the next few years to give rapid improvement to all of our business. We expect to see a significant improvement of the economics of Qantas International, Qantas Domestic and Jetstar in the coming year, but there will be significant benefits coming through for the international business. We are not going to be giving an expectation of when it'll get back to break even. Needless to say, the target around the whole Qantas transformation programme is to improve all of our businesses. Steve?
Hi, Alan. There are already people out there sort of calling for your head. Do you think you'll be able to get past the $2.8 billion net loss and explain the underlying improvements sufficiently to counteract that?
Well, there's always people out after my head, Steve. I don't think that changes, hasn't changed for a long time. The reality is, looking at these results, that we had an underlying loss of $646 million. Let's explain where that loss has come from. There were two big drivers of that. One is fuel costs were up year on year by $253 million. Secondly, we've seen capacity levels, both internationally and domestically, now for a number of years outstrip demand. 9.5% growth in international capacity. That resulted with an over 3% yield revenue hit on our international business. That was over $560 million. That position, though, we are improving because the Qantas transformation programme is delivering accelerated benefits. Over $200 million in the last financial year, and we're expecting to deliver over $600 million this year. That's why we are outlining an outlook statement that says the worst is over and this business will go back into an underlying profit for the first half of the year because the transformation programme is delivering. The $2.6 billion associated with the changes to the international fleet are a non-cash charge. They relate to the fact that we've set up a new corporate entity for the international business to give us the structural and future options associated with that business. They involve writing down the aircraft, the A380s, the 747s and the A330s, down to essentially the market value as a consequence of that decision. These were aircraft that were bought in 2000 and ordered in 2000 when the exchange rate was very different, and it was the right call at the time. But the exchange rate has moved, and it's moved from, in the case of the 747s, 57 cents to 93 cents. These aircraft will be written down to the true market value and represents what the replacement costs of those aircraft are going forward. And that non-cash item has taken the losses, these confronting numbers. But going forward, as I said, we're optimistic that this business will get back into underlying profits, and the transformation is our focus to deliver the returns and to deliver this business back into profitability.
Just one more, yeah. Well, I noticed there wasn't sort of really any mention of how the Emirates alliance factored into this. Can you give us some details on that?
Yeah, the Emirates Alliance has been absolutely fantastic for us. We've seen significant traffic levels going over Dubai. The customer ratings that we're getting over our Dubai hub is the best that we have on our network. We're getting a lot of people availing of the greater network out of Dubai into Europe and to North Africa. And we are seeing the benefits coming through areas like our exit from loss-making routes on the continental Europe, but providing a better customer proposition to more destinations, like increased redemptions and increased earn of frequent flyer points on the European network, where our customers loving the options that has entailed, and us offering a better value proposition to the corporate accounts in Australia by giving them a better network into Europe and North Africa. So the benefits that we saw and believe are coming through this partnership are really good for us. And this partnership is adding to the desirability and the approach that we have on the Qantas international business. Jeff?
Oh, Helen. Just beside, next to
Sorry, there's
Steve.
some very bright lights, so apologies, Jeff.
With the restructuring of the international, with the tremendous operational experience of the 787s with customers, etc., with Jetstar, can you give us some colour into the options, the 50 options of 787-9s you've got?
Yep.
And whether you're going to exercise those options and to what airline?
I might get Gareth to talk about that. Gareth?
Yes, so Jeffrey, those 50 options and purchase rights still exist. We've pushed back the first couple of those back from 2016 into 2017. And we're very much looking forward to exercising those options and purchase rights and bringing those aircraft into the Qantas fleet. We've got to get through the transformation of the business first and drive the international business into profitability, and we're well on track to do that. And we've got a much more positive outlook right across the organisation. And then we will be making the future investment decisions, and what we've got is a lot of flexibility and some great opportunities to bring some new generation, very efficient aircraft into the Qantas fleet.
I think one of the great things, Jeffrey, here as well, it's worthwhile mentioning, is how many aircraft we're still taking within the group. We took over 20 aircraft last year, another 10 coming this year. 737s and 787s are still arriving. We are seeing the fleet at the youngest it's been now for 20 years. And our customer ratings, with all of the product enhancements and the new fleet, are record levels across all of our businesses. So the investment that we've made, I think since I've been CEO, we've bought over 150 new aircraft, nearly half the fleet. Over the last few years, it's been a major refleeting of our business. And of course, we want to be at the forefront of new aircraft technology going forward. And the turnaround in this business and the delivery of the Qantas transformation program is key. And we have all the signs that we are delivering that. We are turning the business around, and that puts us in a position to look at the future fleet requirements for our operation, and it puts us in a healthier position to be able to order them.
Just breaking in there, because we've got to say goodbye to viewers on ABC One. If you want to continue watching this, you can turn to ABC News 24.
The 5,000 redundancies you've already spoken of?
As we've said, and very clearly in the speech, and very clearly we've said for some time, that the $2 billion transformation program involves 5,000 redundancies. There's no more planned. There's no more involved in it. 5,000 is what we are implementing. That's needed to turn the business around. Any speculation that's been out there around this has been wrong. We are focused on the 5,000.
Alan, hello. David Flynn from Australian Business Traveller. You've mentioned that Jetstar saw an underlying losses group of 116 million, but domestic remained profitable. You said there was a strong surplus in domestic, which would obviously have offset the international loss. So I'm wondering if you can split out how profitable Jetstar domestic was to better assess the size of the loss from international. So to what extent international is being propped up by domestic?
So we've been very clear in our numbers about spelling out what's happening in the various Jetstar businesses. So we've seen the associated businesses, which are the businesses that we have a minority stake in, losing $70 million, $20 million worse than the prior year. That's because of the start-up associated with Jetstar Japan. Jetstar Japan is making rapid progress, now consists of nearly 60% of the low-cost market in Japan. We're seeing significant improvement in yield, and we expect that performance to significantly improve over the next year. The Jetstar Singaporean operation, Jetstar Asia, lost $40 million during this period as a consequence of significant capacity being added by competition up there, which has resulted in all carriers in Southeast Asia losing money. Tiger's losses were significant. AirAsia X, I think, had significant losses. But we are seeing alleviation of that capacity situation. It did generate a lot more impact on yield across the board. And I should point out that Jetstar in Singapore had been profitable for the 4 years prior to this. But we're optimistic about the outlook again on that business with capacity rationalising, and we expect the profitability of that to improve going forward. As I said, we believe there's substantial value in these investments in Asia, and we are committed to those businesses going forward.
Okay, good. Now, with the pushback of 21 A320neos and turning them into A320neo orders, will all 99 of the group's orders for the A320neos go to Jetstar, or will we expect to see them in Qantas mainline or possibly Jet Connect?
So we have made some fleet changes to the A320 order and converted COs to NEOs and pushed them out to the end of the delivery stream. So those aircraft are now out into the 2020s. But the plan is, and always has been, that these NEOs will replace the existing COs within the Jetstar group. A large proportion of Jetstar's aircraft are leased, were leased when Jetstar started. And as those leases roll off, we will roll in the new, more efficient NEOs over time. But we have a strong order stream with a lot of flexibility, again, to bring in these very efficient aircraft over quite a long period of time. Within the Jetstar group, yes.
G'day, Alan. It's Mike Smith from the Fin Review.
Hey, Mike.
Can you talk a bit about your longer-term vision for the airline once you get through the transformation? I mean, there's been a lot of changes to the Qantas strategy over the years, and I think investors want some confidence you can return to the airline to sustainable earnings growth. So just wondering how you're going to do that. Where is the growth going to come from further down the track?
Well, I think on the premise of the question, Mike, I think there's been a lot of consistency with the strategy over the years. We've very much been unique in the globe, as you know, about having a two-brand strategy, being participating in the premium market and the low-cost market. That's generated very significant returns over the years. And as I said, even in the domestic market, with all the pressure and competitive activity, we still have two profitable airlines operating in that market. And our view is that for the Qantas premium product, we continue to invest in that premium product, continue to make sure that we grow that business going forward in the premium space and maintain our very strong position in the corporate market. And we're making significant investments to do that. New lounges, new aircraft, new products. We're also expanding, and have been over the last 5 years, very rapidly, our loyalty programme. Which generates very solid loyalty to our domestic and international business. That loyalty programme has doubled in size in the last 5 years. It's been huge growth, from 5 million to 10 million members. Profitability is more than doubled. And we see double-digit growth for that business going forward. And we're investing in new products, innovating like Qantas Cash, like Qantas Acquire, which are amazing schemes, both in the small and medium size, but also diversify us into other revenue streams. We want to have the lowest cost operation in the Australian market, and Jetstar continues to deliver on that, very focused on lower airfares, but delivering it at very good customer service levels. MPS in Jetstar is improving every year, delivering low airfares with great customer service, and we think that's the key and the core to the Qantas Group. We do need to get Qantas's domestic cost base down and to be at competitive levels, and this transformation programme will deliver on that. It will deliver significant improvements in that cost base down to competitive levels. And then for international, it's a great airline. It's a great brand with great reputation. Its cost base hasn't been right, but we are very much focused on that with significant cost reductions in the last few years. And that business is growing on areas where it can make money. In the last a couple of weeks, we announced extra capacity to LA, to Santiago. We've announced new co-chair partners. We have more destinations on Qantas internationally than we've ever had, over 1,200 of them. We want to expand that reach with our own aircraft, with partners' aircraft, and we want to do it in a sustainable way. And where those opportunities exist, we go after them with good targeted growth. We also believe that our Asian franchises give us huge opportunity in the fastest aviation market on the globe. We are making very good progress in Japan. As I said, think of this as an Australian brand. Now the largest low-cost carrier, nearly by 50% over the next nearest. 60% of that market, rapidly growing, rapidly improving in economics. A lot of airlines would like to be in that position in the fourth largest economy in the world. So there's very consistent views on what we need to do and what we need to deliver on, and we are delivering on it. And that's why we do believe that we will get the group with this transformation program, which is the #1 priority for the strategy of the business, to get this business back to underlying profits in the first half.
Mr. Joyce, Philip Lasker from ABC, over here.
Sorry, Philip. Yeah.
I just wanted to know, the sale of your loyalty program, is that off the table? Is that something that could still happen while you're running Qantas, or is that option dead? And can you give us a little more detail on why you decided not to consider that option at this point?
Well, first of all, we had a structural review that covered everything within the business. As I said, it looked at non-core assets, it looked at Jetstar in Asia, it looked at our Qantas international and domestic business, and it looked at Qantas loyalty. And we have, out of that, decided to sell some non-core assets. We've decided to do this holding company and structure for Qantas International. And in relation to Qantas loyalty, as I said on a couple of occasions, it was a very complex and needed deep consideration. We have decided there was insufficient justification to do it, so that position is clear. We're not going to do it, and that has been the outcome of this review. This business is a great business. It has a lot of growth going forward. We've made massive inroads in terms of growth, and as I said, in the last 5 years, doubling the size of the business, doubling the profitability of the business, and we are targeting double-digit growth, and we believe that our shareholder value still for us holding that business going forward and delivering that growth to our shareholders over time.
So that's not going to happen on your watch, basically?
As I said, we've been very clear on it. We're not going to be doing Qantas loyalty. I made the decision that there's insufficient justification to do Qantas loyalty.
And what's your attitude on domestic market share? Do you still draw a line in the sand as to your market share where you won't see a drop below a certain point, or has that changed?
Our position on our domestic position has always been very clear, and I suppose we've simplified this sometimes by saying 65% line in the sand. It's been more complex than that, making sure that we have a network and frequency advantage for Qantas across the board as a product advantage. That product advantage, we believe, is really critical. It's delivering the results in the corporate market, because we still have over 80% corporate market share. I think in these numbers, we talk about retaining 180 corporates during the year. We've lost 10, and we've regained from the competition 8. Part of the reason why we are being so successful in maintaining our position in the corporate market is because of our network, our frequency, and the destinations we serve, as well as our loyalty program, our product, our on-time performance. But they all go hand in hand. And we will protect that position going forward. But we do believe that given the market circumstances we're seeing today, with weakness in the resource sector and government travel in particular, that it's sensible for us not to grow capacity for this half, and that is our outlook and that is our position. Similarly for Jetstar, we want Jetstar to be the lowest cost operator with the best network for a leisure carrier operating in the market. Jetstar has far better economics than its competitor, lower costs, better revenue. That's because it offers a better network, and we are going to protect that and making sure we maintain that competitive position. But again, there has been some weakness in consumer confidence, and we're making sure we're targeted and where we place growth for Jetstar.
Hi there, Alan. Can you see me?
Yes, I can.
Okay, good. David Fickling from Bloomberg. Just with the restructure on the international, a couple of things on that. I mean, you've looked at this before and you dropped it at the half-year results, and now it's come up again. I was just wanting to understand why the position's been changing on that. And also, do you see international as always having a position within the listed company structure, or is there the potential for it to become unlisted in the way Virgin's done?
So our position, just to be clear, at the half year, it hadn't changed. We always were looking at what we would do with structure going forward. What we said at the half year is we were pausing the creation of a separate AOC, which is an operating licence, and we said we were pausing that because our focus very clearly was on the transformation programme, and making sure that we delivered on the changes that we believe was immediately necessary, and that's what we focused in on. You want to answer the second?
In terms of the structure, we are obviously looking to put it into a separate corporate structure. That is different from where we were at the half year as well. The AOC process could absolutely still take place within the same corporate structure. But now we're looking to provide a new corporate entity in which to house the international business. That will be part of the group. It will be 100% owned by Qantas Airways Limited, but it provides optionality for potential investors to enter the business at different levels. And this is about optionality for the medium to long term, and about potential for bringing external investment into the group, and particularly into the international business over the long term. We're not actioning anything today. We're not actively looking for a partner today, but we're structuring the business in the way that provides us the maximum level of optionality to be involved in partnerships, alliances or consolidations in the international business over the long term.
I mean, to be clear though, from what I can see, you'd only get that benefit if it goes unlisted, or are there other ways to achieve that?
I think what we're saying at this stage is that we're creating options for ourselves, and the structure allows us to have different options, and that will depend, as Gareth said, in the longer term, what dialogue we get into, what options are available to us. And at this stage, that's what this is focused in on. So we're not going to have definitive rule stuff in or rule stuff out, because we want to create optionality for us going forward.
Just one last thing. One analyst was commenting to me. People do always ask. You've had a tough run as CEO. How have you survived for so long? And one person said, "Look, you don't change horses mid-race. There's a lot of tough stuff to clear up. Once that's cleared up, then Qantas can move on." What's your take on that?
Well, I think from our perspective, we are, as a management team, and me particularly as CEO, are focused on turning this great airline around, coping with the environmental challenges that we have, and making sure that we get this airline back into profitability and to grow the business in all parts of the business going forward. We're fully behind that. We believe the transformation programme is the way to do it. We're making inroads on the transformation programme, and we believe the worst is over for us now. And we have given a positive outlook statement of getting this business back into profit for the first half, subject to factors outside our control. The management, the CEO, the board are fully behind that and very focused on delivering on it, and we are making progress in that direction. And that determination, I think, is key. And that passion that we all have for this great business, I think, is key. And nothing is stopping that passion from going. We really want to see Qantas survive for at least the next 90 years.
Ross Greenwood from the Nine Network, Alan. Notwithstanding the passion that's there within the organisation that you describe, would you in hindsight describe it as a strategic mistake of the board and the management to pursue the domestic market share, which has plunged that previously highly profitable organisation to at least a break-even situation at best, given the state of the international airline and the losses that it was sustaining?
I think, Ross, that you have to look at the strategic position in the domestic market and saying, is Qantas still number one for business, and has it maintained 80% by revenue of the corporate market, and why has it done that? Why has it been in a position where it's solidly protected its position? That's because the strategy has been right. You know, people in the past have actually questioned whether Jetstar was the right strategy when we first started it. People have questioned whether the protection of the frequencies and network in this occasion are the right strategy. At the end of the day, in the long term, they'll be proven to be the right strategy because we believe that fundamentally the Qantas Group will be the largest, most profitable and still be the #1 for business and the #1 for the low-cost leisure market because of the strategy we're undertaking, and we're fully convinced of that. I think there is a weakness in the market, as we said, at the moment, and that's why we are zeroing capacity growth, because the resource sector and the government sector are showing weaknesses, and we do think the market needs time to digest that, and we are seeing lower levels of growth than we have for some time, and this gives some stability now, I think, into the domestic market. Questions on the phone? First question.
We have a question from Ross Kelly from the Wall Street Journal. Please go ahead.
Hello, Ross.
Good morning, guys. Just to clarify on the structural separation, does that make it conceivable that, you know, more than 49% of either the domestic or the international business could be owned by foreign investors?
No, to be very clear, no more than 49%. The Qantas Sale Act changes that have been, as I said, signed into law by the Governor-General on Monday removed the airline ownership of 25% and 35%. They have not changed the 49% cap on foreign ownership. And the international business is also subject essentially to the Air Navigation Act, which means that it cannot be owned any more than 49% by foreign ownership. So there is no proposal, there's no thought, and we're not structuring this in any way to avoid those restrictions.
Okay, and just secondly, while there's clearly some differences between Qantas and Air New Zealand that you guys can't control, you know, given the real contrast in the performance between the two airlines, do you think there's anything that they're doing well that Qantas could be doing better?
So I think, first of all, I think there were good results from Air New Zealand. I think you're right, they're not comparable because there's apples with oranges in that. I think when we look at, first of all, Air New Zealand have gone through in the early 2000s a rapid transformation program which has benefited them. We're doing that transformation and going through it. The environment for Air New Zealand is different because their fuel costs actually came down. Ours went up because the Australian dollar moved against the US dollar by 11%. The New Zealand dollar didn't. And we see a very different competitive environment with capacity being added. And I said our two big hits this year were negative 253 million in fuel and negative over 500 million due to the surplus of capacity. So I think you can compare different airlines and different environments because it's apples with oranges.
Okay, and just one more from me. The Hong Kong joint venture seems to be getting held up for quite a while by the regulators there. I mean, are you seeing any signs of a breakthrough?
So we are, as you know, a minority shareholder in Jetstar Hong Kong. Pansy Ho is the chairperson from Shuntak and China Eastern are involved in it. And we are committed to that business. Pansy is leading the charge of getting the approvals, and she continues to be optimistic about getting there. And I think any other questions on this should be directed to Jetstar Hong Kong.
Okay, thank you.
We have a question from Jennifer Hewitt from the Australian Financial Review. Please go ahead.
Hello, Jennifer.
Thank you. Hi. Look, obviously, you know, some time back you were hoping from more assistance from the government in terms of a guarantee. Can you give us any estimate of what you think has been the cost of not getting that for you? And in terms of the structural separation, you say you're not doing it to get around any of the restrictions. Can you explain, I know you've talked about optionality, but can you explain what the purpose of it is then?
Well, let me answer the first part and get Gareth to talk about the second part. The first part, Jennifer, I think it's very clear that we went through a dialogue with the government in the past. That's in the past. The government decided that was going to change the 25% and 35% of the Qantas Sale Act and has implemented that through as a bipartisan approach with the Labour Party. We've now had that signed into law. we're now getting on and making the appropriate changes and acting as a consequence of those changes with the structure that we thought. We are focused on the transformation programme and turning the business around. Any speculation of what could have and what wouldn't have happened, depending on circumstances in the past, is academic. We just want to be focused on the transformation programme now, and the issues and the changes of the government are behind us. They've been concluded as far as we're concerned, and now it's all about transforming this business.
And in terms of the structural changes, obviously the changes to the Qantas Sale Act have removed a significant impediment for Qantas to be involved in long-term consolidation, and we want to take advantage of that. By providing a separate subsidiary for international, we do increase the optionality, because today the headstock is well over 40% foreign-owned, and the ability for a foreign investor, foreign airline, whoever it might be, to take a significant stake is limited because of that. So by providing a separate subsidiary, you give an option for that foreign investor to take equity directly in the international business. So it just increases the options and the optionality. That's what we want to do by putting this separate structure in place.
And as Gareth said earlier, this is all about long-term optionality. We are focused now in the short and medium term on the transformation programme. We're not actively out there looking for an airline investor. This is long-term optionality for our business. The number one priority is delivering on the transformation programme, and that's what management's focused on. Jeff?
Alan, can I take you back to Jetstar and then take you across to New Zealand, and perhaps you can give us some colour as to what's happening over there with Jetstar New Zealand?
Yes, I mean, I think Jetstar in New Zealand is actually a very good story, Jeff. We've seen a significant improvement in the performance of the airline over there. It had a period of time when it started operations where its on-time performance and reliability weren't great. I think the team led by Jane and David Hall have done a fantastic job of getting better on-time performance than the competitor, getting the reliability up. We've seen a significant improvement in loads and in yield. The market's been a lot more disciplined in New Zealand than it has been in Australia. There hasn't been the oversupply of capacity that we've saw here, and as a result, I think all carriers are doing well in that market because it is sensible adding capacity with growth and not ahead of growth.
Jared Frawley, Australian Aviation.
Hey, Jared.
You mentioned earlier about, I think at the end of the transformation, there'll be a 5% unit cost differential between Qantas domestically and your competitor. Is that the group or Qantas mainland?
That's Qantas domestic mainline.
Right. So can you tell me what the differential is at the moment?
It's in the pack. We believe that we've come down from 18% down to 15% this year. And we'll have that confirmed tomorrow when we see the...
So there's another 10%
to go, yeah, and there's significant amount of benefits that will flow through to the domestic business as part of the transformation. A big one that will occur during this current financial year is the retirement of the 767 aircraft and the introduction of the fleet simplification and the utilisation benefits that come from that. So that will be a big step in closing that cost gap.
Carla Selner from Australian Associated Press. Can you just give us a bit of an idea where this sits in terms of, well, where this last period and today sits in the 94-year history of Qantas? And just a secondary question, your own remuneration, has that changed, or is there going to be any change in your own remuneration?
Well, first of all, as we said, this has been the biggest and fastest transformation in Qantas's history, because the environment that we're dealing with has been the most demanding and the most challenging that we've ever had. We've had record levels of fuel, $4.5 billion in fuel this year. We've had record levels of capacity being added, as I mentioned, 9.5% internationally. It has absolutely been the most challenging environment that we've faced, and the results as a result have been confronting. But we have hope, that the business is on the turnaround, and we are strong in our outlook statement that this business will get back into profitability subject to factors outside our control, because we are making the right decisions, the fast decisions to turn this business around, and with the help of our people we're still delivering a record customer satisfaction, record on-time performance. While morale has been low, engagement has been extremely high, and this business is rising to the challenge and making sure that it gets back into profitability. In terms of my remuneration, it's been very clear at the half year. I announced the base salary cut and total remuneration cut, and my remuneration will be down 40% this year. That's great. Thanks very much.